Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's Tax and Financial Services over in Brentwood, Tennessee. She is a tax expert for individuals and small business owners and can help you with all kinds of tax issues. All right, we've got a caller, and this is Kenny. We're going to talk to, if I hit the right button, Kenny, welcome to the Retirement Report. Hi, Kenny. Can you hear me?
Yes.
Ah, there we go. Good morning. How you doing today?
I'm pretty good. How are you?
Excellent. How can I help this morning?
Yeah, I was just wondering. I'm disabled. I'm on Medicare, and I have money in a 401k.
Okay.
And I was just wondering how I can get that out. The cheapest way, I guess, without being penalized or the lowest tax.
How old are you, Kenny? Kenny, how old are you?
60.
60? Okay. Well,
Well,
tax-wise,
1 plus, you avoid the penalty.
yeah, he's going to avoid the penalty, and theoretically, if he does it in increments, he could pretty much do it tax-free.
Yeah, basically what we would look at is seeing, so you don't need, right now, are you able to live on the disability and Medicare coverage that you have?
Yes.
Okay, so what we're looking at then is what's the most tax efficient way and not impact your benefits at the same time, right?
Right.
Okay, so what we'd do there is we'd sit down and put up a schedule, and as far as how to do it, on the tax rate part, are you single or married?
Single.
Okay, so for you can, looking at it, I think that the same number applies. I think it's around $16,000 a year, somewhere in that $16,000 a year range that you can make without it impacting your benefits.
Right.
So so in terms of how much we would be looking to pull out, we'd probably, based on the standard deduction exemption, I would probably stick closer to around $10,000.
That's what I was just going to say. Yeah.
And around 10, you could, pull that out. Shouldn't affect your benefits, and at the same time, you wouldn't have any tax on it. All right, but I'd want to look closer, make sure we're not
when
missing
I took that, when I was on the 401k,
right,
it was pre-tax is how I did it.
Right.
Yes,
So
exactly.
now I have to pay tax on it when I withdraw it, right?
Well, not necessarily. That's right. See, because one of the things you're going to look at depends on how much. So if you were to try to cash, I don't know how much is in it, but if you were to try to cash the whole thing out, it could create a tax for you.
But we have a trick.
If we just, all we want to do is minimize. So if you've got a standard deduction of around $6,000 and an exemption of $4,000, that's $10,000 approximately that you pay no tax on. So if we were taking out $10,000 of your 401k, now again, I'd want to make sure there are no other income things that could throw that off, but we'd make sure of the calculation. But somewhere in that range of $10,000 or less, then you would have no tax on it.
And you just take it out every year.
I thought I would have to pay, what, the 15%?
No.
Not if, again, the key is to minimize how much you take out per year, and you stay under that standard deduction exemption, and you can avoid the tax.
Completely.
Okay.
Yeah.
So I thought I had to stay underneath it to not go over that amount you're talking about and go up into another tax bracket.
Right.
No,
And
there's a 0% tax bracket.
I thought no matter what I had to pay that 15%.
Here's how that works.
So I don't.
So in a situation, basically, depending on, now you're, on that standard deduction exemption, approximately $10,000, zero tax. The next 9,000 something, 10% tax, and then over that 9,000, approximately up to about 37,000 in your taxable income is taxed at 15%.
And he'd have to be careful.
So this is that progressive system.
Because the disability can become taxable if we start doing, I mean, it's a Social Security. You're getting your disability through Social Security, right?
Yes.
Okay. So, yeah. So, again, keeping it probably around the $10,000 and paying zero tax, and then just doing that depending on how many years you have or how much money you have in your 401k would be the smartest, especially since you don't have to have the money. It'd be nice to have, but it's not like I'm going to starve to death if I don't have the money. This would be a great way to, he does this with several of his clients actually, where they convert it if you don't need it, and then you're getting it back tax-free. You put it in tax-free and you're getting it back tax-free. It's grown tax-free. You can't get a better deal.
The only one that loses is the IRS,
yes!
And we're not too worried about that one.
Exactly.
Me either. That's great.
All right. So if you need any more help on it, just give us a call. We'll be happy to help you with that, okay?
Yeah.
Thank you. That was wonderful. I appreciate it.
All right. Take care. Thanks, Kenny.
You did. Thank you. You have a good day. Bye-bye.
You too. Bye. this is one of the things, again, that understanding the progressive tax system that we have.
Right.
So we just went through a system for someone that's single. An example, again, if I'm looking at a married couple age 65, current law, $23,400 is the combined standard deduction, 2 exemptions.
Right.
That $23,400 is 0 tax. Okay, you pay no tax on that amount of money. The next piece that comes in, the next $18,650, 10% tax. That's all you pay on that amount. So if you combine those, that's about $42,000, and your total tax would be about $1,800. All right, so that means that your total tax on that is somewhere in the neighborhood of basically about a little less than 5% is your tax rate on that total amount. Right? See how that works?
Rate.
Yes.
Now,
the next is
portion of their Social Security, if they have Social Security at that age, could start becoming taxable. So you end up with dollar for dollar.
Exactly, and this is one of the
careful.
reasons when we get into this, we talk about these different tax brackets and how they work and understanding. But now the taxation of Social Security can come into play. All right, we're going to talk about that. I'm going to grab a caller, and then I want to come back and we'll talk a little bit about Social Security and taxation of Social Security and how you have to really watch some of the things that you do because of what impact it'll have on your Social Security benefits as well. All right, but first we'll talk to Ann. Ann, welcome to the Retirement Report.
Good morning. Thank you. My question is, I will be approaching 70 and a half next year. So I'll have to take that RMD.
Yes.
So how often do you have to take that?
Oh, great question.
And how do they determine what the amount is that you have to take?
Good question. Good question.
Excellent question. So you're looking basically with the required minimum distribution 70 and a half in the year in which you turn 70 and a half, you actually have a choice whether you take it that year or the next year and take 2 in the next year if that's the case. This is another area where we get into, Friday and I will work out, I'll say, well, we'll run the taxes. I'll say, well, if the person takes RMD this year, it could trigger a bunch of different things like taxation of Social Security benefits or other impacts that it may have on the taxes. So we'll look at, well, would they be better to take it this year or delay a year? Because even though it'll be double next year, the amount of RMD, if the tax rate ends up being less overall, because this year they pay less tax, let's say even 0 tax, there can be some benefits to be had. All right, so that's an exception. Now here's the other part. 70 and a half, you have to take it that year and each and every year after that. All right, and the way they calculate it is they look at your total retirement accounts, traditional, not counting Roths. You do not have to take money out of a Roth IRA as far as required minimum distributions. So on your traditional accounts, 401k, 403b, TSP, IRAs, SEP IRAs, all of this counts in the same way. Then they look at the value of those total at the end of the tax year. So let's say 2016, December 31st, or for you actually, let's say for this year. At the end of this year, December 31st, 2017, whatever those accounts value, that's the dollar amount they're going to use the divisor. The divisor is 27.4 in the first year. So if you turn 70 and a half next year, Ann, that means that they would look at the total of those accounts at the end of this year, divide that amount by 27.4. That would be the amount of your RMD.
Which is roughly what, 4%?
About 3.75 in that first year. So let's say you got 100,000 in total account value. That would be approximately 3,750. All right, if you've got 500,000 or $1 million in there, then you're talking about $37,500.
Now she doesn't have to take it. She can take it monthly. She can take it yearly. She can take it monthly.
Yes. Now you can break that down. How you take that? You can take it as an annual payment. You can have it set up automatically with your custodian or a number of custodians. There's a lot of different ways that you can take the RMD. You can have it as a monthly income coming into you. You can have taxes withheld from it. And in answer, the other part of your question is you have to take it each and every year. The dollar amount would likely, if it's properly invested, will likely grow. And the divisor that's used will also, the percentage also goes up. So the amount you have to take out normally goes up every year as well.
Oh, okay. Well, I have called in to sign up for your consultation and all that stuff. So, yeah, I'll get more information when I get an appointment with you to do that.
Excellent. I look forward to seeing you.
All right. Thank you. Have a good day.
You too, Ann. Take care. Bye. All right, we're going to take another quick break. Join us here. We'll be right back on the Retirement Report.